Have you ever stopped to think about how two completely different worlds, the gritty, old-school business of drilling for oil and the super sleek, fast-moving world of tech stocks could possibly be connected? Well, they are, in a big way. And today we're going to unpack that surprising link between the price you pay at the pump and how the NASDAQ performs.
And look, this isn't just some abstract economic theory. We literally just watched this play out in real time this past April. Oil prices started to fall, and almost immediately, the tech-heavy NASDAQ started to climb. So what's the deal? How does a barrel of crude oil pulled from the ground in Texas end up causing a stock rally in Silicon Valley?
And we're not talking about a tiny little bump here. Between April 15th and 17th, the NASDAQ shot up a full 2% in just one session. And what was the trigger? Well, analysts all pointed to the exact same thing. Oil prices were falling because the Strait of Hormuz reopened. It just goes to show you this connection isn't just real, it is immediate and it is powerful.
Okay, so to really get how this works, we're going to follow the ripple effect. First, we'll dig into what we call the inflation tailwind. Then, we'll see how cheaper gas puts more money right back into your pocket. We'll also look at the tale of two very different markets. And then, this is the most important part. We'll explain why the reason for the price drop is so critical. And finally, we'll touch on what you should watch for next.
All right, let's jump into that first ripple. The absolutely massive impact that falling oil prices have on inflation and interest rates. Honestly, for tech stocks, this is probably the single biggest piece of the puzzle.
This is the chain reaction right here. It's like dominoes. First, oil prices fall. That helps cool down that sticky inflation that's been hanging around 3.1%. Suddenly, the Federal Reserve has a little more breathing room, and they can start thinking about cutting interest rates. And for tech companies, that is everything. See, their stock prices are based on how much money they're going to make in the future. Lower interest rates make those future profits worth a whole lot more today, and boom, their stock valuations just take off.
And beyond that big picture interest rate stuff, there are some really direct bottom line benefits for these tech companies. Just think about the enormous data centers that power the cloud. They use a staggering amount of energy. So cheaper oil means cheaper electricity. It also means it costs less to ship all that computer hardware around the globe. It all just feeds right into better profit margins for them.
So let's move on to the second ripple, and you'll see how this all starts to build. This is where the story shifts from Wall Street over to Main Street. And yeah, probably right into your own wallet.
It's a pretty simple concept, but it's incredibly powerful. Every single dollar you don't have to spend filling up your car or heating your home is another dollar you can spend on something else. Economists call this pocketbook savings, and when it happens across the whole country, it gives a serious boost to disposable income.
So where does all that extra cash end up going? Well, investors start making bets that it's going to flow straight into these consumer discretionary companies. We're talking e-commerce giants like Amazon, streaming services like Netflix and Apple, and just the retail and entertainment sectors in general. It makes sense, right? When people feel like they have a little more money to play with, these are often the first places they go to spend it.
But, and this is a really big but, it's so important to understand that cheaper oil isn't a win for everybody. While the NASDAQ might be popping the champagne, other parts of the market are definitely feeling the pain. It really does create a tale of two very different markets.
You can see the split so clearly. On one side, you have the winners. Companies where fuel is a massive, massive expense. Think about airlines, shipping giants like FedEx and UPS, manufacturers. For them, cheaper oil is a direct shot in the arm for their profits. But on the flip side, you have the energy sector itself. Companies like ExxonMobil and Chevron, well, they obviously get hit hard. Their profits are tied directly to the price of oil, and when they fall, it can act as a real drag on the broader indexes like the S&P 500 and the Dow.
Okay, now we are at what I think is the most important part of this whole explainer. Up until now, we've kind of assumed that falling oil prices are a good thing. But that all depends on one crucial detail: why the price is falling in the first place.
It really all comes down to the story behind the drop. If oil prices are falling because of good news, like say a country increases production or a conflict gets resolved and supply lines open up, that's a bullish sign for the economy and stocks usually rally. But if prices are falling because demand is collapsing, well, that is a massive red flag. It can mean a global recession is right around the corner. In that scenario, the entire stock market, tech included, could fall right along with the price of oil.
Okay, let's tie this all together. What does this all mean for you if you're watching the markets? What are the key things to look out for?
This table is a great little cheat sheet for the relationships we've been talking about.
So if we see a supply-driven drop in oil, you can pretty much expect a bullish or positive reaction from the NASDAQ and airline stocks. At the same time, you'd expect a bearish or negative trend for oil itself, and of course for the energy stocks that rely on it.
Now, if you're really watching the charts, there's a key bit of trader lingo you need to know, and that's the WTI support zone. All this means is that it's a price level where, historically, a bunch of buyers have jumped in and stopped the price from falling any lower. You can think of it like a safety net or a floor for the price of oil.
And that critical floor for West Texas Intermediate crude is right there in that $60 to $70 a barrel range. So, if we see oil break below that level, and we know it's because of increased supply, that could be the green light for a brand new, really powerful rally in the NASDAQ. That's the key level everyone's watching.
So that brings us to the final question, the one you can now answer. The next time you see oil prices tumbling in the headlines, you'll know not to just react. You'll know to ask the most important question. Why? Is it because of a healthy increase in supply, or is it a worrying drop in demand? Because as you've just seen, the answer to that question changes everything. Thanks for watching.